Here we are, guys, and welcome back to my new video. This video is my first one in English, but I hope that there'll be others in the future. So till then, in order to support the channel, please give me a like and subscribe. And so I would say that we can start. So, is the recession just around the corner? I don't know. Let's see. First of all, we have to take a brief look at the 2008 crisis, aka the real estate crisis. However, the real estate bubble was not the only factor that created the crisis. In fact, several factors made it possible. Of course, there was a clear real estate bubble due to subprime loans. But among the other factors, we can find CDS and ABC, namely fixed income instruments held by retailers and institutions, whose underlying were those subprime loans. Then we have to mention the widespread leverage in the investment world, leverage that affected also the fixed income instruments we have seen before. Among the factors, there was also little regulation on the markets, owing to the excessive laissez-faire of the Fed and its chief Alan Greenspan. Moreover, the huge Far West in the OTC market did the rest. In fact, the OTC market is a deregulated market in which only subjects with specific requirements can operate. Due to its deregulation, very dangerous practices were widespread. Lastly, also rating agencies such as Fitch or Standard & Poor's played a cardinal role. These companies guaranteed the safety and the solvency of the financial instruments mentioned earlier. Since the agencies were considered reliable, people invested their money without doubts, but lately they lost everything. From a point of view, nowadays there could be a recession, and, as it was in 2008, this recession could be the sum of many problems. We will look at the inflated prices of the market, of course at the beer spread, at the crypto world, at the Chinese real estate bubble, the growing inflation, the economic cycles, the tapering, and the uncertainties related to climate changes. Firstly, in my risk list, we find the inflated prices on the stock market. Among several indicators, I chose to have a look at two: the historical PE ratio of the Standard & Poor's 500 and the Buffett indicator. Here we have a line graph of the PE ratio of Standard & Poor's 500. The price-to-earning ratio is a ratio that measures the current share price of a company relative to its earning per share. PE ratio determines the relative value of a share. The lower it is, of course, the better it is. According to the graph, today's market is way overvalued, with a PE ratio that overcomes the ratio of dot-com crisis, and from my point of view, it is a clear alarm signal. Now we can look at the Buffett indicator. This indicator was created by Warren Buffett, one of the most famous investors ever. This indicator assesses how expensive or cheap the stock market is. Consequently, it shows if the market is overvalued or undervalued, compared of course to his historical average. We can see that the indicator is at its highest, and it is screaming overvalued, namely an overvalued market. However, in the past, we were used to higher interest rates compared to today's ones. For this reason, the low interest rates we have today could mitigate and justify the incredible growth. Nevertheless, I wouldn't be that calm, because this indicator, speaking from my point of view, deserves respect. So, it is another concerning signal, I would say. We now arrive at the second point of my list, the virus spread. It is undeniable that the virus situation continues to cause various concerns. Concerns not only at an health level, but also at an economic one. New restrictions could sentence the closure of many businesses, which would leave tens of thousands of workers at home. Consequently, these ex-workers would be forced to limit their outgoings, namely their expenses, and this would lead to the activities still open to see their income reduce. Therefore, there would be the risk of a vicious circle, which would involve the whole globe. In such a risky scenario, it is at least strange that many stocks continue to grow incessantly. Third point of the list, the crypto bubble. 2021 was perhaps the year of the consecration of crypto. In 2021, a meme coin, Shiba Inu, overcame another meme coin, Dogecoin, and reached a capitalization of $33 billion. As well as Shiba and Doge, many other cryptos exploded, we can say. And if about some it is undeniable to give merit for innovation, among them we can say Ethereum, it is also evident that this growth has been too fast and too widespread, as well as senseless, I would say. Looking at the bar chart, it makes me mad see that Shiba reached a capitalization of 33 billion. More than Twitter or Domino's Pizza, and not too far from eBay. That's crazy, guys. Another observation regarding this world is the fact that cryptocurrencies have brought many young people closer to the world of toxic investments. Toxic because many of them, namely the guys, don't even have the slightest idea where they are putting their money or where they are investing their money. They do it only to follow the trend or because they are attracted by the illusion of making easy money. If this were not enough, the majority of them believe that cryptocurrencies can be defined as currencies, but the definition of money or the definition of currency is not something abstract. In fact, a currency must be accepted by all as a means of payment for goods and services. A currency can't be scarce. A currency must be unit of measurement of the value. Moreover, must be reserve of value, namely not subject to strong fluctuations. Moreover, a currency must be divisible and devoid of intrinsic value. Connected to the world of crypto, there is also that of NFT, non-fungible tokens. At the end of the summer, an NFT, a digital portrait consisting of a few dozen colored pixels, was sold for $532 million, more than a framework by Leonardo da Vinci. Here you can see the NFT sold for the crazy amount. Incredible, guys, that's really incredible. I found it interesting to attach the graph of NFT market cap. You can see that the growth follows the trend shape. It is a rapid increase, and as every trend, it could fall very soon. I also decided to bring another example about the crypto world. This time is about the crypto Omicron. This crypto has nothing to do with the virus mutation, but since the discovery of the mutation, the crypto started to grow at an impressive rate. Another example that shows us the volatility and the unsafety of this sometimes, I would say, senseless world. Next step, Chinese real estate bubble. The Chinese real estate market is creaking a lot. The situation not only worries Beijing, but also the whole world, given that in today's globalized world, if the bubble were to burst, the effects would cascade across the globe. International attention was drawn for the first time by the Evergreen Case, a company operating in the real estate sector, construction and more. The company has over 300 billion in debt, and if the company were to declare bankruptcy, it would hit creditors around the world. Another cardinal aspect of the situation is the fact that the real estate sector is one of the drivers of the Chinese economy. So the collapse of Evergreen would involve many other sectors. After all, China has been pursuing real estate construction campaigns at very high rates for almost 15 years, both in the field of infrastructures and in the field of residential constructions. The problem is that the buildings are not built following the logic of the market, for example following the law of supply and demand, but are regulated by local governments, which derive 50% of the sales of building land and decide where and when is possible to build. We find now another risky signal, inflation. The bar chart shows the inflation growth, namely the generalized increase in prices in the US. This increase, the highest since 1990, mainly affected foodstuffs, price of gasoline, new and used cars, means of transport and agricultural products related to wheat and corn. The same inflation started to affect also the Eurozone. The inflation in Europe is dragged by energy, but there is a clear uptrend in all the other fields. This chart is eye-catcher, from deflation to inflation in a very short span. Not only the US or Europe are affected by inflation, except for Japan, the entire developed world is suffering this generalized increase in prices. Another risky signal is provided by the raw material index that touches its highest since 2015. Of course, this increase in raw materials cost brings increases in stuff prices, and it's not a good thing for families, which will see their bills increase. Inflation is something that touches us daily, and people are concerned about it. Here, Bloomberg illustrates in the line graph how people are worried about the increase in prices. People haven't been this worried about inflation for decades, another bad signal. Last but not the least, economic circles and tapering. During the history, many examples support the cyclical nature of the economy, that is, the alternation between periods of recession and periods of expansion. In fact, the alternation between periods of growth and periods of decline has always characterized human history. The last period of a recession for Western countries and more generally for developed countries ended with the end of sovereign debt crisis in 2013. From that point on, we entered a period of expansion. However, due to the cyclicality, this period cannot be eternal, and a span of recession, after almost 10 years, can be expected. I didn't consider the black swan that happened on the market during the first wave COVID, because the fall and the recover were so fast. In addition, there wasn't a proper recession in the economy, but just a block due to restrictions and lockdowns. The increase in subscription of put options, which touches the highest level since March 2020, reinforced my bearish view, which, according to the graph, seems to be shared with many experienced investors. One strategy to buffer the rise of inflation is tapering, which is the opposite of quantitative easing. We talk about quantitative easing when central banks buy assets on the markets, in particular government bonds. This happens in times when it is necessary to boost the economy, lower the rates, and inject liquidity into the markets. Quantitative easing is now proceeding uninterrupted by the sovereign debt crisis. The purchase of securities by central banks, namely Fed and ECB, increased during the pandemic, in order to give the countries more money to spend to fight the COVID. However, the increase in money in circulation leads to rising prices, giving rise to inflation. Tapering is used to fight this inflation. The banks finish their shopping on the markets. This should, of course, reduce inflation, but in the meantime it leads to an increase in rates and to suffering for the majority of stocks listed on the markets around the world. If to all we have listed so far we add the uncertainty related to climate changes, the situation appears anything but calm. So, thank you for looking at the video. Please give me a like and subscribe to the channel. Sorry for my pronunciation errors, and see you on the next video. Bye bye!